mud.
Thanks for listening to Investor Insights, a behind-the-scenes look at investing with Fund That Flip. This series provides an insider's look at how our business works and answers your frequently asked questions so that you can make better investment decisions with your hard-earned capital. Now, our founder and CEO, Matt Rodak.
Welcome to this episode of Fund That Flip's Investor Insights. I'm your host, Matt Rodak, founder and CEO over here at Fund That Flip. And today joining me on the show is a friend, a business partner, and a fellow Ohioan, Dan LaSpina. Dan is an insurance professional at insurance brokerage Todd and Associates. They handle all of our corporate insurance and have also recently helped us develop what I think anyway is a pretty cool and innovative program for our borrowers, helping them place insurance pretty easy, pretty seamlessly, and also hopefully saving them some money. So some really, really interesting and good stuff. And Dan really just knows a lot about insurance. So we're going to have him on the show, and we're going to be breaking down some of the more important parts of a property casualty insurance policy, specifically for those that are investing in real estate. So with that, welcome to the show, Dan.
Hey, Matt. Thank you. Appreciate it.
Glad to have you here. So before we jump into the details of insurance for real estate investing, maybe just give us a little bit of your background on yourself, your experience, how you got into the wonderful world of insurance, and anything else you think is useful.
Sure. So I started out, I was actually in college. I was working as a contractor to kind of, just make money and pay the bills. When I graduated, I went straight into carpentry, did that for about 5 years, and really just loved building and homes and all that. I had some health issues and needed to get out of that. So I met a guy who was running an agency, and he said the best training was at Progressive. So I went to Progressive. Their whole interview process was there for about 6 months. And then I went to State Farm. I was there for a few years. And after about 1.5 years ago, I came over to Todd Associates. Just wanted to transfer over to work with, more carriers. I have more of a focus on commercial insurance now. A lot of investors, contractors, things like that. Mm-hmm. And that's about it.
It's an interesting background. So you went from being on the side of being a carpenter and creating the risks, if you will, to now being on the other side of it and protecting those guys. So that's cool.
Yeah, I think it's helped me a lot, honestly.
Yeah,
just in understanding what clients are doing, because I've been there and done it.
What actually is happening on a job site, like better than anybody.
Right.
That's cool. So let's get into it then a little bit. And I think in my background, actually, before getting into this business, was insurance. So I know enough to be dangerous and at least asking some questions. And I think maybe a good place for us to start in helping everyone understand just some very simple things to look at is first the type of policy form that your insurance is written on, right? So generally speaking, from kind of my understanding of the world, there's really like 3 different types of insurance policies specifically for property. The first is what's called, I believe, a basic policy. The second is which is called a broad policy. And then the third is called a special policy, or oftentimes an all risks policy. So maybe you could just walk us through kind of the differences between these different types of policies, and like what's the kind of the main takeaway or the main thing you really need to understand between the different types of policies.
Sure. Yeah. So really the basic policy is the lowest policy you can get on these properties. And it's only providing coverage for perils that are listed. So risks or damages that are caused to your home need to be specifically listed on that policy. Usually it'll cover fire, lightning, wind damage, things like that. But that is it. So it's the least comprehensive form of coverage. And a lot of times insurance carriers try to do it for very old homes. So usually you'll see it if a home was built before 1900, they're trying to throw basic on there. If you have that on your homeowner's policy, it's a really good idea to call an insurance agent and try to move up to a special form policy. The broad policy is one step up from basic, and really it's just going to include all of those basic perils and then they'll add a few others. So everything that the basic and broad form cover need to be specifically included on the policy that the insured receives. If it's not listed, it's not covered. And then the special form policy, they used to call all risk. They stopped doing that just because it is misleading. It doesn't cover everything, but this is actually an exclusion-based form. So if it's not excluded, then it is covered. So the big difference is the policy that you're going to receive with a basic and broad form, they're going to list what they cover. Everything that's not on there, they won't. And the special is just going to list what they won't cover. Most of the policies that we write now are in special form unless there's something that is completely not allowing us to provide it.
Got it. So the key takeaway here, I think, is make sure you have a special form or an all risk form. And I think this is like super important. And this was a concept that took me a little bit to like wrap my head around. It was like, well, yeah, if we just list everything on the broad or the basics, like what's the difference? But the reality is you can't think of all the different things that may cause a loss. So like the all risk form kind of has you covered, right? As long as it's not excluded, you're likely to have coverage. And I think the big thing too is like whose onus is, who has the onus to prove there's a covered loss on the first two forms, the basic and the broad. Like it's kind of you as the insured to prove you have a loss of like, hey, like this is in the form, it's covered. Versus the special form, it's more of the insurance company's responsibility to say, hey, you don't have coverage, right? So
right.
Simple thing to look for, but if you see a basic or a broad on your, where would people be able to see this? Obviously, it'll be on their form, but is it on like their certificate of insurance, or where else would be a good place to look for this?
Sure. So any of the, I'm a broker, so I work with numerous carriers, so a lot of them have them on different places, but you should be able to see it on the quote that you receive, and it should say right there, whether it's right beside the dwelling value, it's going to say basic, broad, or special, and it will list coverage type right beside the coverage that's provided. Same on the certificate of insurance. It'll be listed there. And it's a really good idea. I mean, just to interject this with special form, if you don't have that, or even if you do, you can ask for it. And special form, if there's something excluded that you're worried about, ask to include it. There are endorsements to add things. It might cost a little bit more on the annual premium, but you have nothing to lose.
And this is something that I know, having been in the business, almost no one ever reads their insurance policies, which, like I'm sure frustrates a guy like you, but like at a bare minimum, like look for the type of form that you have, make sure you have a special form. And then I think if you don't want to read the whole policy because they are super long, like assuming you have a special form, flip to the exclusion section of the form and read what's being taken out of your coverage, and just try to think
Absolutely.
like, hey, do I need this type of coverage? And at that point, you can have a conversation with your agent to see what can be done to add some of that stuff back in. So, all right, really simple tip that I think almost everyone should understand. A lot of people look at limits and deductibles and some of these other things, but if you've got the right limit and you've got a deductible you're comfortable with, but you're on a basic form, you may not have some of the coverage you need. So, simple thing to look out for. All right, so let's move on to another concept that is also super, kind of confusing and complex, but I think, we can distill this down, and that goes to this idea of coinsurance. So, oftentimes what you'll see on a policy is some type of a coinsurance provision, and it'll say 80% coinsurance or 90% coinsurance or 100% coinsurance or no coinsurance. Talk to us a little bit about like what is coinsurance? Why do carriers, insurance companies put coinsurance on policies, and then we can kind of dissect it a little bit on how to be thinking about it.
Sure. So, coinsurance is a lot different in property than it is. A lot of people think health insurance and things like that. It's different. It's basically just the insurance provider or carrier holding the borrower and the insured responsible for carrying adequate limits on their property.
Yep.
So the 80% is
so standard. Why is that important, right? So like, I think it's important to note, right? Like the reason that they want you to carry the right limits is they're charging a premium based on the value of the home, right? So if you've got a a $200,000 home and you're saying, oh, like I only want $100,000 of insurance, the carrier is only going to be charging a premium on that $100,000 kind of number that's been reported, when in fact you've got a $200,000 asset, right? So the coinsurance is like a mechanism, right, to help the right. That's the point, right?
Yes, it kind of takes the full responsibility off the insurance provider and make sure that the insured is properly reporting everything. So it's, especially in your world with a lot of investors and folks doing rehab projects, a lot of people will purchase a home for 50 or 60 grand. They get it for, a pretty good deal. And that's what they want to insure the home for. But, if the home was to be a total loss, it would cost a lot more money than $50,000 to build it.
Yep.
So the insurance provider, one, it's for premium, but two, it's to make sure in the case that the house did burn down and it was a total loss, they don't have to pay out the whole claim if you weren't even insuring it properly.
Yep.
So 80% is the standard. It's the best. If you have a $1 million home and you have it insured for $800,000 or more, then you don't have to worry. When a claim happens, if it were to be a complete loss, it's going to be paid out by the insurance provider, obviously minus the deductible. If it's insured for less than that $800,000, then there's actually a calculation that they would use to figure out how underinsured you were, and they would pay out based off of that.
So I'm gonna rewind that a little bit, because I think this is where it gets tricky, and I think it's worth hearing it a couple of times. So the example that Dan used was you've got $1 million house. You think the house is worth $1 million. As long as you're insuring it for 80%, which is the coinsurance percentage, so $800,000 in this example. If you have a claim, whether it's a full claim or a partial claim, the insurance company is going to insure 100% of that loss. Let's say it's $1 million home and you've only insured, $700,000 value. You're going to be, in the eyes of the insurance company, underinsured by $100,000, and they're essentially going to discount the claim amount by that same percentage that you've underinsured, right? So whether it's a complete burn down or just a $25,000 loss, if you've underinsured your property, you're going to only get a percentage of that claim based on the percentage that you've underinsured. So what a lot of people think is like, well, yeah, I got $1 million house, but like, what's the likelihood of this thing burning all the way to the ground or having a complete loss? That's pretty low. Like, I'm only going to buy $500,000 worth of insurance. Not a good idea, right? Because especially if you have a coinsurance clause, what that means is you're actually assuming some percentage of the loss under that coinsurance. Did I say that right?
Exactly.
Yeah.
Well, exactly. Yeah. So they'll, and I'm glad you said that, because it's, I use the example for a total loss, but it also applies to any other claim that you have. When they go to evaluate that claim, they're actually going to, the way that they figure it out is they take the value of the loss, so the amount of the damage, and then they will take the amount of the insurance that you have and divide it by the amount of the insurance that's required.
Yep. And
that's actually minus the deductible, and that's the form or the format that they'll use to figure out how much they're actually going to pay out.
Yep.
So, it helps obviously to save you money on your premium initially, you think, but God forbid anything happened, it's really only hurting you.
It catches up quick.
It does.
And people, I think this is where people, try to get cute, and they were like, oh, I'm going to trick the insurance company and underreport my value and pay less premium. Like, really, 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 really bad idea if you've got a coinsurance clause, because that's going to catch back up to you.
Well, and and if I could say one more thing on that, especially if you have a loan on the property.
Yep.
If you have a loan on the property and there's a loss, and we'll go back to the total loss scenario, they're going to pay out what you had it insured for, with the calculations, and they're going to pay you less. And you may have a loan that's more than what you get paid. So you're not going to get another house. You have to pay off your loan.
Yep.
With the money that you had, and you have to find more money to pay off the remainder.
Yep.
So it's just not a smart idea. It's not a smart idea.
Yeah, it's starting to defeat the purpose of buying insurance at all at some point. I think the other thing that's interesting, and you mentioned kind of the correlation to, people think of coinsurance like health insurance. If you do have a coinsurance clause, is it better to have a 80% coinsurance or a 90% coinsurance?
In my opinion, I think 80 is the best, because they use a lot of insurance providers. All use different tools that they will figure out what the replacement cost of the home is based off square footage, size, what's in it, everything, how it's built, the year built. You give yourself a 20% gap. I mean, it's just, you have a bit of a room for error. Once you get to 90 or 100%, you need to be positive that it's insured correctly.
Right. The point is, if you have a coinsurance clause, which most policies are going to put on, is actually a lower percentage coinsurance clause is better than a higher, which may be kind of counterintuitive, but again, think of it as like a margin for error on insuring to the appropriate value, as opposed to like what percentage the insured is going to pay, right? I think that's the difference, right, between the health coinsurance is like that acts more like a deductible, I think, or like a percentage out of pocket. Like in this case, it's more of like how much margin of error are we giving ourselves to get the value right, and obviously the wider the spread there, the better off you are.
Right. The health insurance is the amount that you're responsible before the insurance carrier is going to pay out, and it's really you're co-insuring yourself.
Yep.
Co-insurance on property, like I said, is just the insurance carrier's way of holding you accountable, of giving adequate reporting on the property value.
Yep. So something super important, again, pay attention to that. Pay attention to your coinsurance percentage, but also pay attention to how you're reporting the values. And I don't think it's wise to try to save a couple of bucks on insurance premium by underreporting values, because that does catch up to you, not just on a complete loss, but also on partial losses. So I think there's also, right, a type of kind of valuation. Maybe it's worth mentioning. I don't know how often we see it in this space, but the idea of a agreed value or a policy with no co-insurance clause. What's kind of the benefit of having that if you can get it?
I mean, if you can get it, it's really there. In layman's terms, it's just the insurance carrier believing what you're saying and how you're reporting the value of the property. So it's kind of up to you. Even though there's not a clause, it's really putting all of the responsibility on you as the borrower or the insured. Whatever you reported for is what you're getting. So it's still just, no matter what, it's always important to be as accurate as possible.
Yep. Cool. Next thing I want to talk a little bit about is, right, so is really how losses will be calculated in terms of the developing a number for how to calculate a claim, right? So I think there's really, generally speaking, two ways to look at this. The first is on a replacement cost basis, right, and then on an actual cash value basis. What are the differences between replacement cost basis and actual cash value basis?
Sure. So replacement cost is the actual cost of replacing the damaged property. So they will replace any damages with new property and new materials at full value.
So let's use an example. So like let's say
Sure.
I've got a house in Ohio, and a tornado comes through and blows my roof off, and the roof was 15 years old, right? So I've got this claim, I've got no roof. If I've got a replacement cost policy, the insurance company is going to say, okay, it's going to cost you $20,000 to put a new roof on, and they're going to give me the $20,000 to put a new roof on because that's the cost to replace my roof. Is that fair?
Exactly.
Okay.
That's fair. Yep. And then the actual cash value is the replacement cost of replacing it minus or less the depreciated value and any use or wear. So in that same example, if it's a 15-year-old roof, but you're insured on an actual cash value basis, and it's going to cost $20,000 to fix it, they're going to give you less based on the condition it was in before you lost it.
So they say, hey, a normal life has a 30-year life. You're halfway through the value of your roof. So, we're going to give you $10,000 instead of $20,000 because what you lost was a roof that, was really halfway through its useful life. And therefore, the real the real kind of loss here is not $20,000, it's $10,000 because in 15 years you would have had to replace the roof anyways.
Exactly. They might say, you as the property owner, as the insured, it's your responsibility to keep up with that. It's your responsibility to make sure that your roof is in good condition. And, if it's 15 years old, hey, we're going to give you $10,000. We don't really care what it costs now. This is what it was worth before you lost it.
Yep. So how do we see this playing out? Like, is replacement cost basis typically across like the policy and all losses will be adjusted on a replacement cost basis? Is it, on a per peril basis or a per type of property basis? Like, how should we be thinking about replacement costs versus actual cash value? And where does that kind of show up typically in the policy?
So most of the time on a regular homeowner's policy, a standard homeowner's policy, more often than not, it's going to be on a replacement cost basis.
Yep.
Okay. If you'll see sometimes they'll do an actual cash value when the home is very old, because they know they can rebuild it for far less probably. They'll also see it in situations where the house is vacant or very damaged. Mm-hmm. If there's work being done, a lot of times insurance providers will insure it for a replacement costs when nothing's being done, switch to actual cash value while the work is being done, and then back to replacement cost, afterwards. So that kind of applies to your world a bit too.
Yep.
You'll see it on the policy listed, same as the basic form and the broad and special that we discussed before. You'll see it listed right there next to all of the policy coverages.
Yep.
Most of the time, it's going to extend the replacement cost would extend to everything. So it's going to be your personal property, the dwelling itself, which is the structure. Same deal throughout the policy, unless otherwise noted.
So it's another very important, I think, thing to understand about your policy, especially if you're going to be working on a property or renovating it. There's triggers in policies that will change whether or not you're getting replacement cost coverage or actual cash value. Sometimes there's nothing you can kind of do about that, but at least being aware of it and asking for it never hurts. So again, something that can really have a big impact on how a claim is paid is really how that adjustment's going to be done, either on a what's it cost to replace or what's what's the depreciated value is another way to think of it of this thing and getting the claim paid on that depreciated value. So important stuff to look out for certain. All right, so let's move on. And again, we're doing this topic, and we got Dan on here because we did get a request in from, again, one of our listeners who had some questions about insurance and how to be thinking about insurance and what we do to look, when we're looking at the insurance that our borrowers are putting on their properties to make sure we have adequate insurance. So appreciate the suggestion for this content. If others that are listening have ideas, please do send them in to investorrelations@fundthatflip.com. But one of the things that this particular listener wanted to understand better was around natural hazards. So things like flood, wind and hail, earth movement, wildfires, as we're seeing more of these things happen around the country. Let's talk about each one of these kind of individually and what is typically covered under an all risk policy. If it's not covered, how do we get coverage? What are we looking for? So let's start with flood. Flood's an interesting one. Is flood typically covered on your kind of out of the box, whether it's a homeowner's policy or a light commercial policy like we get on these fix and flip projects? Like, do we normally have flood coverage out of the gate?
It really depends. It really depends on where the property is. So most of the time there is coverage for minor water damage, but most policies will actually exclude flood. If you're in Ohio and places that don't really experience it, it might be on there. It's rare.
So flood is typically, in my experience, I think, like if we're talking about a special policy, flood's typically one of those perils that's excluded, right? In the hey, we're going to cover everything except for if there's a loss caused by flood. I think that's pretty fair to say, right?
Yeah, absolutely.
So how do we get it back in, right? And when should we care about getting it back in? Should we, if we're not in a and maybe let's take a step back, right? Like I think understanding flood zones is important. Like what are the different types of flood zones, and how do we know if a property is perhaps exposed to flood, if it's, surface water flood or river flood or ocean flood? Like, how do we kind of understand that?
So the first thing that most insurance companies are going to do are they'll provide, if you ask, they will provide you with requirements for where you're at. So for the flood zone, if you buy a house on the coastal region, they might ask for elevation certificates. They might ask for proof of where you're located and loss histories to make sure there haven't been any flood claims in the past. Typically, you can find that information online. You can ask the city before you purchase the property, but they're going to disclose if it's in a flood zone or not. If the flood coverage is not,
there's things out there called flood maps, right? Like I think
right.
FEMA puts out flood maps that you can search online, or the insurance companies have access to, or oftentimes we even see the title insurance companies that we work with, or the appraisers will even kind of do some flood searches if we think maybe we're close to a zone.
Yeah, a lot of the quoting software that insurance providers have, as soon as you type in the address based off zip codes or area codes, they usually receive an alert because, they don't remember every spot that it's a flood zone. So they'll receive an alert that says, elevation certificate is required or this and that, or they'll automatically exclude any type of water damage, which is then kind of puts the burden back on, the property owner to go out into other programs and buy it separately.
So let's talk a little bit about that. So if we kind of are under the assumption that in most cases, flood coverage is not going to be part of your normal policy. And let's say you are in a flood zone, right? So you're near a river basin, or it's in a what's called either a high hazard or a low hazard zone, meaning like if the river were to get a big rainstorm, there's potential that it rises to the point where your property could be affected. How does one go about getting insurance for that type of scenario?
So if they can't get it through their carrier, they would actually look onto national programs. So there's a national flood insurance program. Local brokers, including myself, are able to sell that. So you'd have to buy it separately. You'd contact us. We would, do our due diligence, making sure we had all the correct information. And then we would provide a quote based off of that. So it would have to be purchased separately, and it would also be purchased for the time, the same as the homeowner's policy. So it'd be a year.
Got it.
Most
step one is ask your carrier, hey, can we include flood? And if they say, you know what, we can't, then I believe the program's often referred to as NFIP, right? Like National Flood Program. So you'd go back to your broker, ask for getting a quote for an NFIP policy, which then would get you some coverage. Can anybody get an NFIP policy, or do you have to be in a flood zone in order to get one?
Most of the time you have to be in a flood zone.
Okay.
As far as I'm aware, there are carriers that will, that do represent the NFIP. So I think we have Selective and I believe Westfield and a few other bigger name companies. So if you have a broker that deals with them, you can ask. Otherwise it's pretty easy to go online and look up NFIP and it'll kind of map out where you need to go.
Yep. And what if I'm not in a flood zone? Should I still be worried about getting flood coverage? And what's the likelihood that I'm able to get it, or is it something maybe I shouldn't worry about?
I mean, from an insurance perspective, I never tell people not to worry. So it's just,
yep.
you should get as much as you possibly can on everything. It's just, I don't know. It's kind of just
safe and sorry.
The nature of the beast. Yeah.
Right.
But you can certainly look out and get an excess policy for flood. So there are other providers that will write a separate policy for your home. Be in the NFIP. I believe you have to be in a flood zone, and I could be wrong on that, but I'm pretty positive you need to be in a flood zone.
I think that's right. Yeah.
And to get an excess flood policy, you would just have to call around and look for companies that are able to add that, or you can ask your current insurance carrier to add an endorsement which covers it.
Get you back to coverage.
Yeah. There are a few options. I know we've actually had experienced this in the past where flood coverage was excluded. This was a homeowner's policy. We were contacted. They asked if they could add some kind of coverage to make up for it, even if it wasn't a flood policy. And over the years, third-party sources have kind of partnered with insurance companies to provide services to kind of help out. So it's not necessarily full coverage. If your whole basement floods from a natural flood, they might not cover everything, but it's better than nothing.
Yep. Got it. So one of those somewhat tricky, I think, things in just because you're not in a flood zone doesn't necessarily mean you're not exposed to some type of flood, especially as we're seeing, some changing weather patterns around the country. So something to at least ask for. And if you think you are exposed, make sure you're looking into NFIP policies and a number of other things. All right, cool. So let's move on to wind and hail. Is wind and hail typically covered under like a special form policy? And if not, like same kind of question, how do we go about getting it?
So wind and hail is typically covered, especially in a special risk policy. If it's not included, you would have to, again, go about that separately. So most of the time, let me just give a list here real quick of basic perils that are going to be covered. We're going to cover fire, lightning, explosions, wind and hail, smoke, any vehicle crashing into your home, riot, vandalism, and then sinkhole collapse or volcanic action. So those are the basic perils that are going to be insured. So windstorm and hail, I know that's kind of a boring list, but it is. Those are what they're going to cover. Wind and hail is usually included. There's usually a separate deductible for it on your policy. Okay. So keep an eye out for that. If you have a $1,000 homeowner's insurance deductible, there will be a separate form on your policy that's going to say your wind and hail deductible is $2,500.
Yep.
So often they separate it, but it is typically included. Florida, they don't love it, right? There's hurricanes and especially high risk areas like that. Same deal. They're usually excluded, or you have to, try to get it elsewhere.
So this is one of those that is, I think, my understanding is typically included. However, what they're going to do is they're going to treat losses from wind and hail perhaps a little bit differently depending on your location. So if you're in the Carolinas or in Florida or in other areas of the country that are higher risks for hurricanes and tornadoes even, the thing you're going to want to look out for is, as Dan mentioned, one, a higher deductible. And sometimes it won't be a flat dollar amount, and it'll be like a percentage of the value of the property. And I've seen these be as high as 5% of the value of the property. So if you've got a $1 million property, 5% of your home, that can be a pretty big deductible. So just understanding what that is super important. I think we've also seen,
just in response to that, sorry, they will actually, companies that do include it, part of that, your rate is based off of the location and the risks.
Yep.
So if you're in a high wind area and they do include it, if you get your quote and it seems really high, that's why they're calculating it in there, because to them, they think there's a better chance we're going to pay out on something with this policy. So,
Yep. So something to look for. I think the other thing that we've seen get their way into these policies is they'll also treat, how they're gonna compensate for those losses differently, right? So they might put an ARV clause in for damage caused by wind or hail if you're in a high area, right? So you've got replacement coverage you think you've got replacement coverage for your whole policy, and then all of a sudden you've got ACV, actual cash value, on your wind losses. So some things to just kind of keep an eye out for, especially if you're in a higher zone wind area. All right, so that's wind and hail. We got flood done. Let's talk about earth movement. Earthquakes, are they covered?
So earthquakes are typically excluded.
Okay, so another one that's excluded.
Exactly. There are endorsements to add earth movement coverage. An endorsement's just an add-on to the underlying policy. Obviously, they're going to charge you more for every endorsement you put on there, but you can talk to the carrier. Like I said before, I hate using that same line, but I mean, there are companies that will work with you. I mean, it really is important to be informed, because if you ask, they might help. If you never ask, they won't. So, unless you're working with a good company. So, typically excluded. You can find coverage that you can include it. Otherwise, same deal. You got to look elsewhere.
So, and I think kind of the point of this session that we're having here for those of you who are listening is like, hopefully to arm you with some of the questions to ask of your agent, right? I think a lot of people assume, they're getting the best deal that they can, and oftentimes it's just a matter of going back and asking for it. And oftentimes, like Dan's in business to win business, and so are his carriers. And if you ask and you've got a good case for it, and they want to win your business, oftentimes you can get some of these things negotiated back in, which, to Dan's point earlier, like you may not need it, but better to have it than to not have it.
I agree. We and you've seen that just in some of the work we've done with you. I mean, we've asked and they've said no to us sometimes, but they've said yes to us on things that we never thought would get added to these policies. Yep. So it's just a matter of knowing what to ask, like you said, and being informed, because we don't really expect, the average person who's buying their first home or to know what to look for in their insurance. That's why they're calling us.
Yep.
So I try to give as much information as I can to people without just completely overwhelming them. But most of the time we know what to look for, and we're going to do our best to add it if it's available. So,
yep. And these guys are great, and they look out for us and our borrowers, and hopefully, you guys can find people that do the same for you. And if not, do spend some time learning some of these things and some of the basic things, because these are lessons that you don't want to have to learn after you've had a loss. That you thought you had coverage for something that you don't, or you thought that you were going to get made whole and you won't because of the way that the valuation or the co-insurance provisions are written. So some simple things and some simple concepts, I think, to understand and make sure you've got yourself covered right. So you don't have to learn the lesson on the back end of a loss. All right. So we got through flood, wind, earth movement, fire. You kind of hit on already, right? So fire is one of those perils that's just in all of policies, and that includes wildfires. I'm assuming these fires that we're seeing out west, like that's just a fire's a fire.
The fire's a fire. Wildfires with some carriers, especially in California right now, they're going to be excluded by companies who aren't very large now. So there's actually something, it's a AM best rating on insurance companies. Pretty important to make sure whoever's insuring you has a or better. It really just is based off the size of the company and their ability to pay the claim. So, the wildfire, you just said the wildfires in California, it bankrupted these companies, and folks didn't have insurance on their home anymore because nobody could pay them. So important to look at that as well.
Your insurance policy is only as good as the ability of the insurance company to pay it. So, understand, right. Great point. Understanding the financial wherewithal of the person that's holding the paper and looking at that AM Best rating is super important. All right. So right. I've got a bonus question for you, and I didn't prep you on this one, but just thought.
Oh man.
So let's see how sharp you are this morning. Mold. Is mold covered?
There is usually an exclusion for any mold in a home. If it depends. If the mold was there before you move in,
yep,
and it wasn't sudden and accidental,
yep.
So every claim is really based off of that. If there was something wrong in your basement and there was a leak for 5 months and you never fixed it, yep, there's a good chance that is not going to be paid out or covered.
Yep.
Mold remediation. There's a coverage for mold remediation that is often an endorsement. They don't want to include it on the standard policy, but you can add it on. But it still is not going to pay out unless it was something that you just absolutely could not avoid. So really, it just goes to taking care of the home. We go all the way back to one of the examples we brought up with the roof when we were talking about replacement costs and actual cash value on that. Keeping up with your home, keeping it in good shape, checking on things and having them fixed when they need it. Your insurance carrier is going to pay out and be more willing to work with you.
Yep.
But circling back to the mold thing, if it's not sudden and accidental, most of the time it's not covered.
So you got a leaking pipe in your basement, and over the course of 3 to 4 months, mold spores develop, and you call your insurance company and say, hey, I have all this mold in my basement. We likely don't have a covered loss. However, and this is the way that I've always thought about mold, is if the mold is caused by a covered loss. So like if the roof blows off, rain comes in, and over the preceding 2 or 3 weeks, like because your house is all wet, like mold starts to develop, you probably got a better case for remediation of that mold, because that mold was caused by a covered loss, in this case your roof blowing off. Is that kind of how you understand it as well?
Exactly. Yeah. And then there's a lot of different things that coincide with the initial cause of loss. So if that initial cause of loss was sudden and accidental, like you just said, wind blows off your roof, water comes in, they're going to cover that more often than not.
Yep.
Yeah, absolutely.
Mold's a good example. And I think, to Dan's point, there's a lot of other things like that where, something may not normally be covered, but if, a covered cause of loss and a covered peril causes that thing to go wrong, oftentimes your insurance company is going to step up and fix that. So it's kind of the chain of loss, I think, as we call it, something like that. Anyways, yeah.
I think a suggestion too, just on that, example, if you're in your basement and one sheet of drywall or something is showing a little bit of mold, have someone come look at it. More often than not, it's not as big of a deal. Unless you allow it to go for a long, long time, you might be able to get a contractor to come out and do it for a couple $100. Yep. When you have a deductible on your policy, that's $1,000. So even if you called and put in a claim, the insurance provider would come and say, even if it was covered,
yep,
it has to exceed the $1,000. So you've really just opened up a claim on your policy that isn't going to be paid. So,
right.
Call someone, have them look at it. It can't hurt. There are plenty of contractors that'll show up for free and take a look. So,
yep. All right, cool. Well, this is great, Dan. I really appreciate the insights here. Super, I think, practical things and some simple ideas for folks to kind of just, get a little bit, hopefully more information and knowledge to ask the right questions of their insurance broker. And I'm a big fan of, ask for the coverage, even if you don't think you need it, because you never know. So try and bring this home for us. So I think kind of the main takeaways here for me is a simple thing for, I think, everyone to do is understand, what type of policy they have. Is it a special form, a basic, or a broad? If you don't have a special form, I think the message here is definitely ask for one. That's going to give you a lot broader coverage. And then once you have that special form, spend some time reading through the exclusions. Again, it's a policy of exclusion. So you're going to have coverage for everything except for what's excluded. And as you're reading through those exclusions, you should be thinking about your business and whether or not any of those exclusions may apply and whether or not you want to ask for additional coverage. The second big piece is coinsurance. You likely have it, which means 2 things. 1, make sure you're reporting the right values. And 2, make sure that coinsurance is closer to 80% than 100%, which would just give you a little bit of margin for error there if you do happen to be off a little bit on your value. And then the last thing I think I have here is just understanding the difference between replacement cost coverage versus actual cash value, and how that may apply at different parts of the policy. So obviously you want replacement cost everywhere, but there may be some areas that or different types of losses where ACV is going to be applied. At a minimum, I think you should understand that, and at a maximum, I think you should be asking your agent or your broker or your insurance carrier to work with you on getting as much replacement cost coverage as you can. I think those are kind of my takeaways. Do you have anything to add to that?
Yeah, I mean that's pretty much it. I'd say the biggest thing too, especially from the investor and rehab world too, is just always remembering that the purchase price of the home is not what it needs to be insured for. You're putting a lot of money into it. This is your investment. Insure it for what it would cost to rebuild the whole thing.
Yep.
That's the goal. And that really is, in a nutshell, why co-insurance exists. That's why, they have these things in place, because they want to insure the home. They would really love to actually do it properly. So just making sure that you have that in mind. And then I would say just, from my experience, being aware that, if you're doing work on a home, if you have issues with it, it might be more expensive than your normal home policy. Just being aware of what those charges are, why they're there, and just asking a lot of questions. If you're working with the right people, questions are okay.
Yep.
So,
yep. That's a great point on just because you paid $100,000 for the house doesn't mean that's what it would cost to replace it. I think to add to that is, oftentimes lenders like us say like you have to at least insure for the value of our loan. So, maybe you bought it for $100,000 and we're giving you $120,000 loan because you're going to be putting $50,000 of work into it. So you buy a $120,000 policy to cover our $120,000 loan. Similar case, depending on what your loan to value ratios are, you may be under insuring the property, which could come back to bite you on the co-insurance clause. So the main thing to remember on that is insure the property to what you think it would cost you to replace it in a scenario where you did have 100% loss.
Exactly. Like you said there, as a lender with Fund That Flip as an example, if somebody took out a $120,000 policy to cover the $120,000 loan, Fund That Flip also has a requirement that you're listed as an additional insured. So when the insurance company pays out, they're paying Fund That Flip.
Yep. So
the loan gets paid back and the investor loses everything. That's $120,000. They lost the home. They great. The lenders paid back, but you've pretty much lost everything else.
Yeah.
So,
not good for anybody. Big thing. Can't be understood.
Yeah,
awesome.
Exactly.
So Dan, let's get out of here on a fun note. When you're not spending time placing insurance policies and making sure your clients' businesses are protected, what are you doing? What do you like to do for fun?
I love being outside. I love outdoors. I like to fish, sports. Love to go to Browns games, Tribes games.
This is our year, baby. The Brownies. This is our year.
Hey, man, it's unlike anything I've ever experienced in my life.
We're getting closer. I feel like
I'm ready for it. I mean, I was actually on my honeymoon and we got the alert that Odell Beckham Jr. was coming. I woke up at 1:30 in the morning and started yelling. So it's pretty neat.
It's going to be It's going to be a fun year. Well, again, this is great. Really appreciate it, Dan. And again, thank you for the feedback out there. For those of you that are sending in ideas, really appreciate it. And please keep it coming. So any ideas, suggestions, questions, please email us at investorrelations@fundthatflip.com. Otherwise, be sure to check back next week for the latest posting of Investor Insights, as well as check out our blog for other great content. Otherwise, again, thank you, Dan, for stopping by, and thank you all for listening, and look forward to having you all back sometime soon. This is Matt signing off.